Takes us to our talk of the tape, even higher stocks. That is the call today from Ed Yardeni. He joins me right now. Ed, welcome back. It's nice to see you.
Thank you. Thank you, Scott.
CPI better than expected. Yields fall. We see parts of the market going up pretty sharply today. What do you make of it?
Well, I think the bull market is broadening. As you know, there was a lot of concerns that it had been narrowing to just a handful of stocks, the so-called Magnificent Seven. But I think today's an important day. I think this is the day where investors are starting to rotate out of the Magnificent Seven and into the rest of the market. I don't think this is going to continue to pull the S&P 500 down. I think there's going to be enough money to keep the leading stocks that have done so well fairly elevated. But I think we are going to see more gains in the S&P 493, as well as in the mid caps, the small and mid cap stocks.
So this is the start of something, because that's been the great debate. When this broadening would happen, there's been some teases before, but you think this is legit?
Well, I think it's legit, partly because the Fed has changed my mind in terms of where interest rates are going. We still think that the economy is doing well enough with inflation moderating that there's no real good reason for the Fed to lower interest rates. But Jay Powell has made it very clear, the Fed chairman has made it very clear that they really do want to lower interest rates. And so I think now the market is absolutely right in anticipating a 25 basis point cut in September. I don't think it's going to happen in July. And so now we're actually going to see interest rates come down. As you know, at the beginning of the year, the markets were expecting 6 to 7 cuts, and that just never happened. This time around, I think the rate cut is coming.
That feels like that's what the takeaway was over the last couple of days, right? The chair on the Hill, I thought pretty explicitly set the table on what is to come. Nick Timiraos, the Wall Street Journal, writing after that appearance that Powell, quote, made the beginning of a pivot on interest rates that might prove more durable than one that sparked a big market rally at the end of last year. That's what you're talking about.
Absolutely. And I think the key thing is that the Fed now is balanced in its assessment of the dual mandate. In other words, unemployment is just as important as inflation, whereas before inflation was the key. They were just totally focused on convincing us that inflation had to come down before they started lowering interest rates. Now they're basically signaling that, you know, we're getting pretty close there. And, you know, excluding shelter, the CPI was up only 1.8% in the data that came out today. And we know shelter inflation is coming down. So I hope they don't ever utter the words mission accomplished. But I think they're getting awfully close to that. And as a result of that, they just want to make sure they don't get a recession, which, again, I think has just been an exaggerated risk for over 2 years now.
Yeah, but I mean, the unemployment rate did tick over 4% for the first time in some years, right? So that obviously put this whole thing on the clock. You could sense from the commentary from the Fed chair himself that that was a moment to pay attention to, and they don't want to let that go any further or any higher and ruin a good story that they think they're going to be able to tell.
Look, that's a reasonable position, but I think the risk that they're taking is if they in fact do move in September and the market continues to expect that this will turn out to be a 1990s style melt up, and then they'll have a whole nother kind of problem with the economy and with the financial markets. I mean, financial conditions are awfully easy for a Fed that maintains that they're being very restrictive. I don't think they really need to ease. But look, it doesn't matter what I think. They're going to do it. And that's going to keep the bull market going, and that's going to help the economy somewhat. And all in all, the labor market indicators to me add up to a labor market that's doing just fine. We saw initial claims coming down a bit today. We saw the continuing claims remaining relatively low. So all in all, I think the economy is doing fine without the Fed having to mess around with the Fed funds rate. But like I said, my opinion is irrelevant here. What matters is what they're going to do, and they've made it very clear. They beat me up over the head that they're going to lower interest rates.